Good morning. Good morning. Welcome to another episode of An Entrepreneur's Journey. Today we're going to start wrapping up how to read a stock symbol. So in this vlog, I want to talk to you guys a little bit about what is a PE ratio. So if you go to Google Finance or Yahoo Finance and you check out any company, any stock, you're going to see a whole list of items. We've already gone through the market cap of a company, and now we're on to the PE ratio. So what is the PE ratio? The PE ratio is the market value per share divided by your earnings per share. So what does this mean? This means, let's say over the last 12 months, the company earned $2 per share, right? And the stock price today is trading at $50 per share. Follow me, right? And the company earned $2 per share over the last year, over the last 12 months, and the stock is currently trading at $50 per share. To calculate your PE ratio, which is what they call the price to earnings ratio, you take the value of the stock, $50, and you divide it by their 12-month earning per share. So not their total revenue, their 12-month earning per share. And you divide that and you get a PE of 25. Why is this important? Why is PE important to buying stock and understanding the stock market? Well, this tells you how much you're paying over the price that they've earned all year for that stock. So for example, if in our example, the company made $2 per share, right? That means every share you bought has made $2, right? Now, stocks rarely trade at the price of what they earn. They trade at a multiple of what they earn. And this is exactly that. The PE ratio is telling you the multiple of what it owns. So for example, we'll give you 3 examples to make sure you guys comprehend this theory correctly. You have a stock price that's trading at $100, okay? And the company made $1 per share. 100 divided by 1 is 100, right? Now you have a PE of 100. What does this mean? That means the stock price is trading at 100 times what the company makes per year per share. So let's do another example. $50 a share. The stock is trading at $50 a share, and the price per earnings is the earnings per share, is $1 a year. This means your PE is 50, right? 50 divided by 1. Let's do another one. Your price per share, we're going to get a little complicated here, right? So your price per share is $43. $43. You can open up a calculator here, right, to make this simple. $43, and your earnings per share were $1.95. Your PE ratio is calculated as 43 over 1.95, or 22.05. What does this mean? This means that the stock is currently trading 22 times greater than it makes per year per share, right? That means for that one share you own, you're paying 22 times what it actually made this year for that one share, right? Which is, you take all the revenue up, so earnings per share is all the earnings, and you divide it by how many shares are outstanding, right? This is a little symbol on the top of your Google Finance or Yahoo Finance when you're looking up stocks. Again, my point in these videos is to teach you guys how to read the stock symbols, right? So I hope I can get that across to you. So that's the PE ratio. Remember, the market value per share, which is basically your stock price, what it's trading at that day, divided by your earnings per share. They also call this the EPS, earnings per share, gives you your PE ratio. Again, your PE ratio is important because it tells you how much over the current yearly revenue you're paying for that stock. Okay? So this is a great analysis. So for example, it's better to buy a stock with a lower PE ratio than a higher PE ratio. Why is this? Because if you're buying a stock that's 100 PE, that means that stock is currently trading at 100 times what it earned last year. per share. If you buy a stock at a 10 PE ratio, it means you're buying a stock at 10 times what it earned last year. Now, do you want to buy a company? Because this is all you're doing when you're buying stock, right? You're buying a company. Do you want to buy a company 10 times more than what it made or 100 times more than what it made? Right? A lot of people say, I want to buy it at exactly what it made. If you're smart, right? Warren Buffett is a great value investor, which a lot of people argue that's the only way to invest. But this basically means look at what they're making. What are they earning, right? If you can find stock that's cheaper, that has a negative PE ratio, you should be in a good boat. Now, be careful. If you find a negative PE ratio, it could be that they're losing money, right? Or that an analyst made a mistake. So in general, you want lower PE ratios. Understand tech companies usually have higher PE ratios. Why? Because the market value is currently factoring in their future return. So if a company is expected to make $10 billion, investors are going to go in, $10 billion more, I should say, than they made last year, right? Investors are going to go in and start buying that stock up, understanding that that price is going to go up. So a lot of times, your revenue or earnings per share, your future revenue and earnings per share is already built into the stock. And the way to tell this is, drum roll, your PE. That's right. Very good, guys. So that is your PE. Let me know what you guys think. If you guys have any questions or comments, put them in the comment section below on YouTube. And if you guys want to learn anything else about finance, pick my brain. I'm here to be brain picked. Let me know what you guys think about the video. Hope you guys tune in next time. Again, this is just my journal, my journey as an entrepreneur, trying to help you guys learn everything that I've learned. Stay tuned. We'll be back next time with another way to read the stock market symbol.